did you know that you were interested in real estate investment at all when you were in college?
No, no, my dad was a doctor. Everybody in my family was doctors, and I was going to go on to medical school. And I actually got into Northwestern's medical school and a few others, and then chose to defer for a year in medical school because while I was interviewing, it was clear that the profession was changing. And I wasn't quite sure, what I wanted to do. So I deferred for a year and then went traveling, but didn't really enjoy not doing stuff. So I got a job at the Board of Trade and then happened to see an ad placement in Northwestern's Career Center for an analyst at J&B Realty, which I knew nothing about. So I went and interviewed there and ended up getting a job starting in first part of January of '83. And then I had actually paid my deposit, which was not good to do. I was supposed to show up in medical school downtown, which I could look at the school right from my office. We were in the Hancock building then. And, I was just having so much fun doing what I was doing. I just never showed up for the first day of medical school. And a friend of mine who's a 6-year vet was calling the roll call. He's like 2 weeks later, he goes, "Where were you?" And finally I knew somebody. I kept calling your name. You never showed up. So I don't know. I think when you find something you really like doing, you end up doing a good job at it because you put your heart and soul into it and the time into it. And that's sort of what happened.
Mm-hmm. So you mentioned J&B. That's where you met Mr. Schreiber, correct?
Correct.
And when did you two decide, let's just go create the largest real estate empire just because?
Well, I don't think that was ever really necessarily the goal, but there's a pretty big downturn in real estate in the early 90s. And John had wanted to retire. And with the various things happening back then, which was much more severe than anything that's happened since, because back then you used to be able to allocate losses, to people. So as a young person, and it was anything over $60,000 of salary was, in essence, sheltered, so we didn't have to pay tax on it. But all that losses that you took, if buildings went back to the lenders, it was as if you sold them at the loan price, which meant you had to recapture from where you'd appreciated them. So there was real personal tax liabilities, not as much for us young people, but for the senior people, you could go bankrupt and potentially end up in jail if you can't pay your taxes. So it was really stressful times. And, John had left, he had to sort of come back, and we talked about doing various things together. And, a few of them we worked on, we never got there. And then he met the guys from Blackstone, and he said, we should really go do this. And I said, well, I'm not sure, we could probably do better if we just do something on our own. Why should we go with the guys from Blackstone? So he ended up about a year or so after that, maybe, doing something with them. I had met with them a number of times and didn't really believe that they would really invest in real estate. So it's a longer story than that. But then eventually, they brought him in because everybody they talked to as a reference, a lot of them gave Schreiber's name. They said, you should talk to Schreiber. I know Schreiber. So they talked him into working, like originally was 40 days a year was his time he was supposed to spend on it. And he'd find, some younger person to run it. So that's sort of how it came about, with a few twists and turns in between. And I think what, John always said, and he said at J&B, if you get up in the morning, you work hard, you do your best for your investors and for your company, everything will work out. So that's sort of just our attitude, was to get up and work hard and find good investments, and everything else will then work out from there. So that was sort of the ethos in the beginning. Our first fund that we raised was only $238 million or so. And 2/3 of it, we had to get approval to invest with. So it wasn't that big of a start, but it grew pretty quick.
Hmm. But it was that big of a finish. What do you think the differences are between investing capital on a mega fund scale compared to a smaller scale? Aside from, you have to choose secular thematic investments, move with conviction, and you have to move with a lot of scale too. And it's hard to steer that ship around. So I suppose you'd have more flexibility at a younger shop. But what is there past that?
What is the what?
What would you say the major differences are between mega fund and
I'd say it's some of them that if you get to such a big scale where Blackstone is now, you have to, pick a sector, as you said, and then, basically buy everything you can, or look at very large transactions that other people can't do. And in the early years, and we weren't that big, back when I knew our biggest fund was maybe about $4 billion. But even back then, we could do, we were one of the bigger funds out there. And we always wondered how would we sell certain investments because they're too big. If we do this, who will ever buy this? It's too big. And in some cases, we had to rely on public execution. So we did merge assets and take stock in public companies. We did do a number of the early privatizations of real estate companies. So now they do a lot of the same things, but do it in scale. And one thing that we always, try to emphasize to everybody at Blackstone, and we do everything here, is that really the most important thing is trust. And that people trust when you say you're going to do something, that you do it, whether it's show up for a meeting or whether it's, close a large transaction. So I think what's really helped Blackstone and still helps it is that if, nowadays if the powers that be at Blackstone, which is, it's basically, I guess it's moved somewhat beyond John Gray, but if we said, okay, we're doing something, we did it. We didn't betray people. We closed it as quick as we can. We didn't drag things out. We made it simple. And people knew that if they came to us or we came to them and said, okay, here's something we'll do, they knew that we'd execute on it. And so there was very little risk for people in doing transactions with us. And I think that's the same at Northwood. If we say we're going to get something done, we get it done. I think that's really the key to a long, successful company is people, having credibility with the marketplace.
Mm-hmm. Some questions about Northwood now. I guess firstly, how are you managing the office portfolio? Is it looking like conversions to residential or what have you, or are a lot of those not working? Are you in key markets where the office buildings are actually okay, or have you come under any degree of distress with those assets?
I think the answer is yes, 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 yes. I think in some ways we don't, handle the market today. The market handles us, right? So every building's different. Every market's a little different. Clearly, there's a flight of capital from office, and clearly, just like with the online retailing and everything, changing distribution and changing shopping to where we didn't have enough industrial, but we had too much retail, and a lot of retail is shaken out over the last few years. There is probably the highest vacancy I think there is now across the country, even more so than the 80s going into the 90s. So the vacancy is huge, and if you have huge vacancy, you're not going to have pricing power. Obviously, the best assets that people want to be in a good economy where, it's still okay to spend money and be in a lavish building. Generally, as a recession sets on, there's sort of, people don't want to be seen as being in the flashiest new building. That hasn't happened yet as we sit here today. So some of the best, shiniest, best located new buildings are basically full, with waiting lists of tenants who want to be in there, but the bulk of the market has significant vacancy. So, obviously some buildings that are older will need to be converted. We've done that in the past. So it's really nothing new except for, I guess, the part that's always true. The good thing about real estate is it's an old business. I used to have a joke about it, but I can't really say it anymore, but real estate's been around forever, right? So it's nothing new. And it's basically supply and demand. And in the old days, recent old days, not old days, but you could know exactly how much, say, office vacancy there is currently, what's being built, which is not much now. And then you could look at the historic growth in population and jobs and triangulate into how many years it will take for the vacancy to drop to a point where you get pricing power again. And it's, simple econ, 101 analysis. I think the hard thing today with changing technology, whether it was industrial, whether it's, what happened in shopping centers, but now on the office side is what will really be the future demand for office. So if you have certain job growth, what percent of those jobs will be in a traditional office going forward? And, it's something I'm, somewhat on the record of talking about, but I don't think it's really has anything to do with COVID or the pandemic. Maybe that, sort of made people get better at doing these types of calls and things. But it's really that everything now is in the cloud. And so our office back in 2018, we still had servers down the hall connected to most people's desks with phones. And we had to manage our servers with our technology department, constantly upgrading for new software upgrades. I think we, got up to having about 10 of them, all different makes, all different ages, different upgrades, different that, and if you wanted to come work on something that was large, you pretty much had to be here to connect to all our servers in an efficient manner. For now, all that stuff's in the cloud. And I can go through, I have slides on a slow transition to, it wasn't too slow, but by 2020, 2021, officially everything, accounting, every single thing we do is in the cloud. So now there's no difference whether I'm, carrying my laptop in here and my desk is over there, but I plug it in, boom, all these screens light up and work. Then I close it down, I take it home. I can be any place in the world and flip it open, and it's no different than if I'm at my desk. And that's for now our accounting, human resources, everybody. So the need to be in the office has changed for most people. Some jobs where you don't really interact with people that much, but used to interact through, whether it's bookkeeping, data entry, human resources. If it wasn't, it's more like, figuring out data plans, making sure payroll gets done. You don't really ever need to be in the office to do those things anymore. So that effect is really going to, it's been accelerating quickly. You can look at graphs of, adoption of technology and how quickly the migration to the cloud is happening for almost every business is pretty significant. So I think that's really what's affected office the most. So our office buildings, some are doing extremely well. New York, I think, is coming back strong. It has a good work ethic. People come here because they want to work, they want to make money, they want to get ahead. The crime isn't bad at all. Public transportation works perfectly. So I'm pretty bullish on New York. I'm less bullish on San Francisco, Chicago, other cities that where people are upset a little bit with what's happening, mostly crime-wise within the city. So people read a lot about New Yorkers, heading to Florida, but they're still New Yorkers. They're still here. They just sort of say, "What do you think? I'm stupid? Why would I pay this tax? I'm in Florida. I'm still here. Okay, let's have lunch tomorrow." Where other cities, you talk to people and they just say, no, I don't want to be there anymore. I just don't want to be there. I'm tired of it. I'm tired of what's happening on the streets. So I am worried about certain cities. In other cities, a lot of the cities that people move to for a lower cost environment, a lot of those jobs may be, outsourced over time. I think the adoption of AI for a lot of what I'll call the more blue collar, white collar jobs could really, make a lot of those jobs obsolete. So I think you got to look at all the different markets and try to figure out what's happening as best you can.
Could you tell us all about Northwood's best deal, Northwood's worst deal, and which you learned more from?
Well, I think you learn, which was our best investments have always been in buying distress, taking more aggressive positions. I think our best investment was buying a shopping center in Barcelona, where it was a very complicated debt structure between people in London, people in New York. We got to know the banks because we were calling on them early on, trying to figure out what we could do, and we're able to keep a loan out of a big bank sale. And we knew the equity owners, so we were able to work with them to get the information ahead of it. We got the debt information, and then we did a very complicated foreclosure in Europe, where we actually sent people to watch when people came in and out of the office, because if we served them on Friday, and they didn't do certain things by Monday, the company would be ours. So we waited till they left for lunch on Friday, and then delivered the papers to the office. And by Monday, we were getting calls because it was too late. It's over, we own it. So that was an intern, and then we sold it, and they did very well. Our worst transactions, probably as we sit here today, because they're more painful, are things that we didn't sell, where they weren't really working. And we said, okay, say we have an office building in Paris, and we said, okay, let's just dump it, just get rid of it and get our money back. Well, we'll just get our money back. We should try to get a little profit. And guess what? Today, if we sell it, we'll probably hopefully get half our money back. So I think when things start turning south, you should just get out of them quickly. So probably some of our worst things are things we held on to too long, that we, for years, said, okay, let's just sell it, but then we never do. It just keeps getting worse.
Mm-hmm. Why is there a disconnect between public and private REITs? Is that a structural function of how they work, or do you think that's a market inefficiency?
Well, I think it is a function of how they work and how the markets work. And obviously, the different group of investors, for the most part, we have different dynamics of when they move money in and out. And the public REITs obviously have a lot of the move with the public markets, also in the capital flows that move in and out of public markets over time. And I generally have always felt that the public markets generally foreshadow what will happen. So I do think that where the public REITs are trading, when they're so far below, not private REIT, we'll call it private market value, it's clearly the private market values are going down. And over time, the REIT values will come up, and they'll meet some place lower than where the private markets are today. The private REITs, as they're structured, and they're now called, that used to just be called the syndication business, which we did a lot of it at JMB. And what they did nowadays is really put a better fee load on it, but it really is more pull marketing, meaning that the brokers drive the money into it when the money is coming in because they get paid to do it. I think in some cases even have a tail on their fee the longer that money stays in, so they don't have any incentive to tell their clients to get out of it. And they have the gates up on it, which allows it, only a certain amount of people to get out. And that the NAV is set by the, appraisers and by the, by the sponsor of that REIT. So I do think the public markets are more directionally right, and the appraisals will slowly come down over time. So I think if I had money there, I'd still be pulling them out.
Mm-hmm. What do you think is a good choice for a first-time real estate investor? So not an institutional scale project, but something smaller, maybe something tax advantaged or something with minimal operational requirements, something that would make sense for someone who's just getting their feet wet.
Like taxes can be very complicated, so I wouldn't let that drive an investment. Although I think if you're doing it yourself, you obviously need to take advantages of what the tax code allows one to do. But I think what you mentioned, having something simpler is probably better. Something that you know about is always good. So I had friends who done extremely well who, after school, moved into the city and bought a 3-flat and renovated 2 of them and bought another one, and they now own, 100, maybe even thousands of units now in the city. They have a whole company devoted to making these things work, but they started doing it themselves. And the good thing about real estate is there's so many different parts to the real estate business that you can do, but doing something you understand, like a small rental program, or even if you don't understand it, but people, understand retail, a small retail center, but I can start small and run it yourself, so how to make cash flow, how to make payroll, how to do all that, and then just grow from there.
What do you think are the most important skills for someone who is, let's say, 2 years into a job and they've mastered the modeling component and they're trying to move up to the next level and provide more value to the team and the firm? Is it generating deal flow? Is it coming up with novel investment theses? Or is there some other component of the job that you think should really be honed in on?
I always tell people here that their most important job is to find somebody smarter than themselves to do what they're doing. And if they do that so that they're no longer relied on to perform the function, whether it's modeling, but you bring in a modeler 10 times better than you, okay, now you can go do something else. And I think that's at every level you're at. And probably the epitome of that was, Steve Schwarzman, who's a great manager, but he'd always say, if you do a good job, you should wake up and have nothing to do. And then if there's a crisis, or then if you have time to, okay, I have nothing to do today, well, let's think about what else I can do. Where else can we take the company? So I think at all levels, even starting out, but making sure that you have a deep bench behind you, smarter and better, right? If you hire people who are less smart, you're going downhill. So you got to try to always find people smarter who will work harder and do a better job of what you're doing. And that frees you up because everything that below you is taken care of. So I think that's, no matter where you are, a good rule of advice.
What's your process for sourcing distressed deals? How do you come across these?
But we've done it. Really, it's something I started at Blackstone, where we again, real estate isn't rocket science, right? So, it doesn't matter where the idea comes from. If you just hear it from somebody, passing by and it's a good idea, then the key is to execute it better. But when there's distress in the market, I even think when there's not, we always say, where should we go when we wake up in the morning, if we have nothing on our list to do, where should we go? And I think it's getting out and talking to people and making personal connections with people. And so, if you think about it today, what people should be doing is obviously going out to see lenders, get out to know the lenders. If you know a lender, okay, well, who's your workout guy? Let's grab lunch, invite your workout person here. And let me get to know, let them know what we can do, what expertise we have. And I think it's always trying to do it in a way where you're wearing a white hat and you say, okay, we're here to help. What can we do? We have capital, we have expertise. What situations we have now, or what are the things coming up in the future that we should spend our time on, and go out and network. So now talking to the banks, had lunch today with one of the mortgage REITs to find out, where they are, whether we could buy the whole company if it was cheap enough, whether we could help them on certain assets, what issues they had. So, we're out talking to all the mortgage REITs, talking to as many banks as we can. I'm talking to the servicers and talking to other funds who have issues, because funds, they only have a certain amount of capital. So, where can we help? In certain funds, not just real estate, but private equity and venture capital with the downturn, many of them, a lot of what they worked for is now not going to transpire into a lot of extra profit. So maybe they want to throw in the towel. Maybe they want to, don't want to go through the tough parts. And we did that last cycle. We bought 2 funds, where the sponsor, the head sponsor just didn't want to go through it again. So we'll talk to their investors and recap it and take it out. So I think it's pretty easy now when there's the stress to know where you can go have productive meetings, because it's a pretty wide thing. There's a lot of distress out there. So you're not wasting your time getting out, talking to people.
Mm-hmm.
I think the harder times are when there isn't distress. And we made one year, we said, let's go find real estate owners who are older than 75. Let's go talk to them, because eventually they're, have some great portfolios. We're able to buy a few buildings down in Soho from an old family, where the patriarch was aging and wanted to clean up some things. So we always come up with some idea. We talked when they were talking about getting rid of the carry interest rule, back in whenever that was 18, maybe 17 or 18, when it was really another political hot button. And we went to some of our friendly competitors who had bought things and made a lot of money. We said, maybe we should sell it now and take your carry before it goes to ordinary income. And, we talked to a lot of them. We found, I think, 2 of them said, that's a good idea. We were able to recapitalize some of their projects at good pricing. So I think if you sit and think about it, and it's harder when there isn't any distress, but you can always find something to sort of anchor your time, and you're calling after them.
Mm-hmm. We have time for one more, and then we'll let you go to your meeting. I wanted to ask about some advice for relationships. Building relationships, maintaining them, so important. Whether that's your, maintaining contact with your close brokers, or you mentioned a workout officer. What about mentorship for undergraduates who are going to the professional world? The best advice I've heard on that front is just throw value at people who you want to be your mentor. Do things for them without them asking. Just be valuable and enjoyable to be around. Is there anything that you think you did that got you in the room with the right people and accelerated the learning curve regarding mentorship?
I think I was always present. I get in early and stay late. Back then you're, had really a 7-day work week, not a 4-day, which I when we moved into New York here from Connecticut, I was like, well, we're not getting enough people in on Saturdays and Sundays. Maybe if we were closer to where the young people live, we'd have more people in on the weekends. So I think being present and then just finding somebody who you can, bond with who's older. I had a fellow at J&B, and it's more probably because I was across from his office and he was always there early. And so he just throws stuff on my desk and say, take a look at this, because I happen to be sitting there. And I didn't know anything, being an engineer. And I run to one of the, guys a few years older. What do I do? What do I do? Okay, take this. Then I'd go in the next day and he'd ask me some questions, and he realized I really didn't know anything about real estate. And so he started having Tuesday mornings at 7 in the morning, an hour tutorial. And he'd give me like a tutorial on how, what a IRR was. And when he first asked me, I went back and looked at the computer, the HP handbook, where they have the definitions of all the calculations. And sort of being an engineer, I studied the equations and how the calculator did all these equations. And then when he went back into answer, I gave him a very theoretical answer on how IRR worked. And it's not what the answer he was looking for. But anyway, I'm just finding somebody you enjoy being with and who somehow is, in sync with you and what you do. And, hopefully you strike up a good relationship.
Any parting words of wisdom?
My shins still hurt because he used to kick me under the table in a meeting if I ever answered something. Because then he'd always say, look, we're here to see what other people know and not what you know. So I think those types of lessons, whether it's getting kicked in the shins at the right time, but you have to have a good relationship with somebody so they know they can kick you in the shins.
I'll turn it back over to you, Cassie. Thanks, John.
Great. Thank you so much, John, for spending time with us today. It has been great to hear your advice and stories and answers to these questions from current students. Students who are on the call who didn't get questions answered, please feel free to reach out to me and I'll connect with Andy and John and Brock and make sure we get answers to questions. But really just want to thank everyone again for being here. Brock, great moderating. Andy, thank you for the intro. And John, really just so valuable to spend time with you to get some insights and advice from your journey. So thank you, everyone. We hope you have a great rest of your day and go Cats.
Yes, go Cats. Thank you, everybody.